Welcome back. Welcome back. We're talking about money today, and I want to share with you a few things that are going on in terms of the interest rate. First, hit that subscribe button if you haven't already subscribed. It's a hard word to say. Subscribed. Hit the button because I'm just going to continue to bring you great information about money, real estate, and sometimes when I travel because I'm trying to do that expat thing. So, anyway, hit the subscribe button. Talking about money today, and before we get into it, I just want to say one of the things my Uncle Zeb used to tell me all the time is that, you know, we play the game, and as soon as we really know how to play the game, they change the rules. They change the rules. So that's what I'm talking about today. I'm going to just kind of go back first and revisit the first time I opened a bank account. I was probably about 13 because I remember my friend Beverly was with me when I went to the bank to put in my own money in my own account. And so this was a whole process. I was about 13, maybe 14, and they didn't really respect me because I was a teenager coming in there to open my own account. Laws and things are really different back then than they are now. But I went in to set up my own account and they just kind of, blew me off as a kid. And if you know my age now, you know that I kind of do a little youthful thing, gray hair absent. I do look a little younger than my real number. Anyway, then I look like a baby. So they blew me off. And, here I am, teenager in the bank, showing my whole entire behind side because they're not respecting me and my money. But anyway, the interest rate at that time was around 4.755%, something like that. I don't know the number exactly. I could probably Google it and figure it out, but I'm not doing all that. I'm just bringing to you that information because we can't go into the bank right now and get that on a regular savings account. We cannot. So that's kind of what we're talking about, or what I will be talking about, and hopefully you'll grasp the information that I'm sharing with you. We need to do better at moving financially when the opportunities come about. When the shift changes, we need to be able to shift with it. For example, when the market crashed in terms of real estate, it was actually a mortgage industry crash. When the bubble burst, it was about the mortgage industry. We were kind of seeing, because I was in real estate at that time, so it was more than 20 years, and I'm in real estate now. We would see a bank fail, and the money wouldn't be at the closing table for whoever was supposed to close that day. They had to figure out something else. And then it happened again. And then another bank failed. And it's like, what the what? Little did we know the entire mortgage industry was about to collapse. It wasn't just the one bank or the other bank. It wasn't just Countrywide, or it wasn't just one bank. It was the entire mortgage industry collapsed. That was back in 2007, and we really began to feel it in 2008 when I, as a realtor, could not find a mortgage loan for a buyer to buy a home for more than a year. All of my clients were cash only buyers, those that could do it. And now I've got people saying, oh, I know it's going to happen again. I'm ready this time. And I just have to inform you folks, that's done already. That rule happened. It's gone. That collapse is not going to happen again, at least while we are here. It'll probably happen in the next 100 years, like the next pandemic will happen in about 96 years from now. It'll happen again. What we probably will see is the kind of slow trickle collapse of the economy under the administration. Well, that's a whole different strategy. We're not going there. But that mortgage industry crash, some are waiting for that to happen, and it happened already. So abandon that. The 3% interest rate, some got 2.67. You're waiting for that against all hope. It's not going to happen again. We did that already. So if you're waiting for the interest rate to come down, it just went down a couple days ago and will probably come down again before the end of this year, 2025. Not to 3%. It's not going to go that low. But what we do need to do is be prepared financially in terms of our savings accounts when that happens. In fact, before that happens, like right now, you need to be looking for a high yield savings account, not just the one where you walk in and put it in your checking account and then in the backup for your checking account, that savings account. No, there's just not enough money. If you've got more than $5,000 that you're saving there to do this, that, or the other, that's just where you're saving, you need to move that to a high yield savings account where you're getting at least 5% on those funds that you're keeping in the bank. Why? Because they're available to you. And if it's just going to be sitting there until you need to do something else or you're saving money to buy a house, you need to be getting more money, more interest on those funds. And in a couple of days, the Fed is going to reduce the rate again. So if you are waiting for the rate to drop, that's great. You want to wait until it drops, but it's not going to drop substantially. While you're waiting, you're also going to be waiting for the interest rate in that account to drop, meaning you're going to be making less money. So we got to be paying attention to both sides of this interest rate thing. I'm going to close this door because someone else is coming in and making noise. So while we're waiting for that interest rate to drop, we also need to be paying attention to the other side of the spectrum where we're going to be losing money in the waiting game. You know, some of the other things that we need to be paying attention to in terms of interest and how much it costs? Insurance. It doesn't hurt to rate shop every now and then because, you know, some of us, we get into, well, that was the same account that or company my parents used, so I'm going to use them too, where you could go to this company or that company and that company. Now, they pretty much all offer the same insurance for home, auto. You get 500 deductible or whatever your plan is. But one company versus the other charges a little bit less. Now, the service might be different, but let's face it, with insurance, it's a racket. If you don't use it, you just paid for it, it's money gone. You almost want to beg for something to happen so that you can reap your money back. So you don't want to do that, but you can shop and make sure that you're getting the best insurance for the least amount of money, right? Of course, that makes sense. So take the time to shop for the best interest rate or the best rate on insurance. You can also check to make sure how long have you been in your mortgage. Check and make sure that the rate drop is going to be something that would be advantageous for you to refi right now. There are some people who bought when the interest rate might have been 7%. And I know with my first house, I was trying to think of how many years ago that was. The interest rate was around 9%. There are people who are still in interest rates that high, and it's lower now. So you can refinance. The thing that you want to make sure is that the closing costs in the refinance are reasonable, and it actually makes sense for you to do it at that particular time. Because if the closing costs are $2,000, it might not actually be advantageous for you now to refi your house. if it's going to cost and not really reap $2,000 over the life of the loan. But if you've got an interest rate higher than 5.5, I believe is where we're kind of hovering, depending on what kind of loan it is. You might want to refinance your house, but consider what it's going to cost in order to do the refinance. Do some shopping on your savings accounts. Yeah, do some shopping to make sure that you're going to be getting the best rate, because one bank to another bank and then another bank, their interest rates are different. They really are, as well as the fees that they charge you for bounce checks or just holding. Listen, you are actually loaning them money by putting your money into that bank account. So check and see that the fees or the rate that they're paying you for the benefit of using your money to loan to other people is worth it. Check and see. You want to look for a high yield savings account, especially if you have money that's in the account more than $5,000, $10,000, $15,000. Look for a high yield savings account. Now, if you are waiting to see that the interest rate is coming down in order to make a purchase of a home, I do want to stress here for you that the 10-year Treasury bond is really what makes the biggest difference in whether or not the interest rates are going to come super low. So yes, the Fed does affect it, but the 10-year Treasury bond is really the biggest factor on whether or not the rates are going to come down. So there are some who believe that you're supposed to buy a house in the spring and summer months and not when it's colder. I would say to you that if you are approved by a lender to buy a house today, that this is the best time to go out and buy a house today. They typically only give you an approval letter for 90 days because the various things happens. The rate changes, you change jobs. There are different things that happen. But in terms of if you are renting and you do not own real estate now, and a bank has approved you to buy now, this is the time to buy. Whether it's cold, hot, spring, summer, it doesn't matter when. Now, if you are currently owning, then you might want to consider a different time to make your purchase. Sure. But listen, I have had the best years, over the years, this is the better way to say it. Over the years, the most busy times have been the last 2 to 3 months of the year. Now, I don't know if that's because so many agents sit down in those times, or people all of a sudden realize that those resolutions that they made back in January, they're about to realize it and they didn't complete the home purchase portion of the resolution. I don't know what it is. I just know that it's always been busy for me. Now, the other thing that you might consider if you're thinking about buying is that so many people believe that it's time to sit down and not get out there, get in it, and make the purchase. Well, then that means that if you're looking right now, you have your pick of the litter. You have your pick of what's available. So get on out there. If a bank is believing in you right now, believe in yourself. Go out there and get shopping. And if you find in a couple of months, a couple of years, that the interest rate is lower, then you can refinance your house into a lower rate at that time. But if you wait trying to get the interest rate to come down, and you wait trying to hope for the home prices to come down, you're losing out on equity right now, because you could be in your home right now. And I've been a homeowner for more than 30 years, and I can tell you that the appreciation of homes, it's about 5% to, I have seen 20% annually. So it's a fantastic investment to make in a home, because paying someone else's rent, you're going to be paying somewhere. You might as well be paying yourself. Yeah, you might as well be paying yourself. Buying a home is basically setting up a account where you're paying into the account. The money that you borrow, you're going to be paying that back every month, annually, while the property value increases 5 to 20%. Do the math. If you're approved, get out there and buy a house. I'm Marvelyn Lewis. I sell real estate in the Atlanta market. Call me when it's time to move and hit that subscribe button.